That is Samir Arora. He joins us at a time when everybody is trying to understand that bhai ye kya ho raha hai? Why have US markets reversed, and if they've reversed, what it means for us? Why are FIs selling, and will they continue to sell? Samir, when we spoke to you last, the market mood was different. We were off to a great start. 2021 closed on a high note, but unfortunately, just when it appeared that we were ready to accelerate ahead of budget, it has come tumbling down.
So I think now the question is whether, because US market is clearly on the back foot and there is no sort of sugar coating it, but US market is quite bad, I think, right now in the short term at least. And we have to figure out whether India, of course, I think India is already outperforming, but whether it can go up if the US market continues to be down. And that we are talking in the short term, say 2, 3, 4 months. After that, anyway, in the medium term, Indian market and world markets and others have seen many, many bad things or tough things in life. But right now, that is the issue because the US market looks quite weak because the language of Chairman Powell was quite strong in terms of saying that data will decide. So far, they were not looking at data; they were just pumping in money because inflation was so low. And now, if they really feel that they have to control it, and it is 7%, which is higher than even what India has, that means they have to raise many more rates, much more than what was originally thought. So I would think that in the backdrop, we have to think that the market will be tougher this time, and then go and do whatever stock selection has to be done. And it makes a bit of a difference to have this big picture thing in the backdrop, because that means that, for example, for us, on average, we had 60% net exposure, but have had over all our life in our long short fund, but last year it was 70%. So, for example, right now we don't believe it should be 70%, but it doesn't mean it has to be 40%. So things like that, that you have to know in the back of as a backdrop that what is the situation in the market, and then you go on and do whatever you have to do, but you do it with a slightly different timetable and pressure on that it has to be invested right now, or if it goes up for a day, do you panic or not? I think those things you don't have to right now in today's situation.
Samir, in December end, the challenge for Indian markets was that we were trading at a premium to the world. On an average, the world is down 15%. We are not down 15%. So the premium only has increased. Is that a very justified way of looking at things?
Well, it can be. For example, if you look at Netflix, Netflix is now trading at this year's multiple of 25 PE for a US company, which is a global multinational, where there's, everybody knows that in the end they may grow a little slower, but they will grow. They just had price hike, things like that. So yes, true that way. I think that's not the way to look at it otherwise, because the way to look at it is that currently the attack is on the US. The attack in terms of the increase in interest rates, the trying to control inflation, and the fact that if you look at the longer term US market returns, I looked at it on Bloomberg, that if you look at it from 1990 to now, broadly speaking, the return is around 10% per annum, if I remember, or depending on which period, because I saw a number of periods. But if you look at it from 2010 to now, it is something like 16% per annum for a long period. That means about 12 years, much higher than the longer term sort of trend line. For India, if you look at it, the 5, 7 year, 6 year return, or even 10-year return, and the 25, 30-year return is nearly the same. So that it's not very far from the trend. So in that sense, US has to correct more. The issue is that if US corrects more, does it make us also come down, or we will outperform? I think is quite reasonable to expect. But will that outperformance mean that we are falling less, or does it mean we can go up on our own, independent of what happens to US? So the valuation is one angle, but you are not really comparing US valuations to Indian valuations. The valuations you are comparing is maybe Chinese valuations to Indian valuations, and there the opinion is strongly divided. Some people who are anal about these things will say valuation is down, and many other people I met, some very smart people I met, say it is uninvestable. It does not have capitalism, and markets need capitalism. because of the shock. Not that they're talking big picture, longer term, what is wrong or right. They're talking about what happened in terms of changing the rules of the game for these companies, for serving a sort of a different purpose or another whatever policy of the government, but the investor had to pay for that.
Let's talk about a sector which you, in a sense, have always believed in. That is the good old Indian IT services. Can you break it for our viewers that should they connect the fall in US tech stocks with the Indian tech stocks? Is it a time to buy Indian IT services companies? What is your view there?
Now we already own it, but it's not the time to buy till these things get resolved, because in the end part of the valuation, see, the thing is, if you the main issue these days, which is why it's more complicated, is that these stock prices are not falling because earnings are falling. These stock prices are falling because the valuation being given to these companies is being changed in line of the new interest rate uh, projections. And that is more difficult to do because nobody exactly knows whether a company should be trading at 30 times or 35 times. Whereas you can say, okay, earnings growth is because, normal old rule used to be that earnings have to be higher than PE. That went away many years ago. So now you're paying for 20% compounding of earnings. You are willing to pay 30, 35 times. But nobody exactly knows whether it should be 36 times or 32 times. That generally comes up by looking at that, okay, it is in line with its recent history, it's in line with other companies in this thing, and it doesn't look way out of line with say a 10-year history or a 5-year history. But those numbers are getting adjusted, and that there's no firm grip that can they fall another 5-10% or not. My other thumb rule is that if you look at some of the other companies in India, say even these new startups or some consumer companies and maybe a few IT companies, if they fall 25%, will you find them cheap or not? In some cases, you may still not IT, but in India, many companies may fall 25%, and you may still say it's very expensive. For example, some of these consumer companies have 70 P. Let's say you drop them 20% in a day and say now the P is 56 or something. I would say it's still expensive. So that is the tough part here. It doesn't immediately become, in some sectors, that wow, it has suddenly become cheaper than it ever was. That's why I'm saying just relax, buy whatever you like, but don't try and buy just corrections for the sake of corrections.
Good morning, Samir. This is Nantara. First up, I'd just like to say I'm really jealous you got to see Ziggy Marley, the son of Bob Marley, live. Nothing like music for the soul, especially when the markets are down. You're very, very lucky. But coming back to the markets, you're saying don't just buy because there's a dip. There's another way of saying buy into your regrets. On top of the show today, for example, Nikunj was saying maybe you need to start looking at the boring stocks again, whether it is textiles, power, energy. Is that your thinking as well? He didn't name the sectors, he said boring. But is that the way one should look at it? Because you also, the way you spoke about startups and IT stocks.
Those are too boring for us. So the way we adjust this value versus growth thing is by saying buy financials, because that also is actually in some sense boring. Don't you think HDFC Bank is quite boring? That it has now some of its best performance, its ROE is more than 2%. It hasn't done anything for 2.5 years, but you broadly know that it is doing well. Recent results, longer term results. So there are many boring things within what we have than to go and buy power stocks and other sticks. Those stocks are too boring for us.
So you'll do value through banks. But what about manufacturing as well, Samir? Because that is where you have started to see excitement on ground, right? The profit pool conversations that are taking place, the capex cycle change that is taking place.
But there are not very many companies in that sector unless you really just label things as manufacturing. We thought we have manufacturing companies. According to us, Dixon is a manufacturing company, but now it is very high P and all, but good growth or very good growth and very good triggers and very good this whole thing about PLI and China plus one and whatever the new thing. That is also manufacturing, if you want to call it that. But the old manufacturing ones, we didn't really find something so exciting, because generally in the past the experience was so bad that it will need more than just thinking that these things are doing well. By the way, specialty chemicals, that is also manufacturing. We own it. So there are many ways we can define what manufacturing we have. But if you say buy these boiler companies or engineering companies, we don't have any right now. We don't have any on the horizon also.
Okay, we're getting into too much of the boring segment stocks. But Samir, I saw you sporting or challenging Ranveer Singh the other day with your bright and colorful Desigual t-shirt. What is that exciting space in the market? I mean, some of these newly listed IPOs as well have fallen a lot. Are you taking a look at any?
So just last slide, I was not challenging him on the t-shirt. I was challenging on my glasses, but people took it as t-shirt, which I don't know. I thought that was my normal t-shirt. Anyway, so I would. Anyway, I will not buy any of these.
Okay, I stand corrected. But then you could have added perhaps Karan Johar as well to that. You could challenge him as well on the glasses.
Anyway, so I will not buy any of the recent listings, because the whole correction in the world is because of these recent listings. And if you see, the whole idea is that these things are benchmarked off each other. So you can't have, say, a DoorDash in US, which has a 40 odd % market share, similar to what our guys have, at being valued only 2 to 3 times more than Indian companies. According to us, the thumb rule for a US to India is like 5% is attractive and 10-12% is outlandishly expensive. If you look at the sort of similar market cap of either sector or companies, for example, if you are comparing, say, in general, a McDonald with some McDonald franchisee or something with something, broadly the ratios are 2 to 5%. So because you can see broadly what is the consumer market cap of, or GDP of the consumer part, and broadly compare it with that. So in that sense, these Zomato types, although we thought initially that a 85-90 price would be good when it listed, and of course we didn't get it. Now, because the benchmarks have all fallen 30-40%, then this is just normal and not something which creates extra sort of this thing, that relatively it has become more attractive. So I would not buy any of these. Also, one more reason why I will not buy is because I read a book recently called the Platform Delusion. And that book is a great book, by the way. And you can put all our Indian platforms in that and then mostly reject half of them in that framework.
Why? Just because of valuations?
Is that every time you read, you get some new angles on how it. No, they're not even talking value. Whether these are really platforms in the first place, not Zomato. I'm saying generally, not talking about Zomato. So Zomato actually, according to me, is a good platform, but it is just that the US benchmarks have fallen too much, and this whole thing has turned. See, the whole thing is, if you look at it, why were these stocks going up so much? Because there was a sentiment, you can say, or a trend in their favor, that everybody knows that 1 year ago you were valued at X, you did a pre-IPO at 2X, and now you're doing an IPO at 4X, and then you'll get listed at 7X. And this was accepted because there were 50 companies like this, and 50 companies had done similar. What can you say? Now suddenly you find that companies are falling 50%. So you will obviously wait. Best example is, look at Robinhood. So that started IPO'd at 38, went to 85. Today was $10, and all in 6 months.
It's like your tweet, na? Aesop's fables. Think before what you wish for. But anyway, Samir, we're also just one trading day away from the budget, and I know the significance of budget for the markets has been reducing over the years. But anything that the finance minister could pull up which could please the markets and lift sentiment?
Well, I think those kind of things which lift sentiment would have to be done directly with capital markets, which I don't think any of that is happening. So I think that, they will reduce STT, or they will do something better with capital gains tax and bring it in line with other markets where foreign investors are not charged. So I'm not thinking any of that. Therefore, I would think that the best is if nothing bad happens to any sector or something which looks that there is still, just sort of a randomness by, giving some sector some benefit and which makes it look, which has happened in the past with many budgets. So I would think the best in the budget would be if there's no bad thing. I think let's take it like that.
A status quo budget basically is from the capital markets perspective. That's what everybody keeps talking about. Samir, can I just go back to the basics, right? Because you, for example, use the word attack. So one would imagine when someone is attacking, how do you defend? So, I asked you that with the way of asking boring question, boring stocks, growth, defensives could be the way. But you have also always been of the view that what has happened in the markets, and the last time you were here, was not liquidity driven. So what is really going on?
No, I was saying in India's context because I was showing you only the actual FII flows. See, right now the problem is in the US, I'm talking. I don't know how to connect it to India because, as I said, we didn't see any FII flows. The flows that we saw were mostly going to private equity and startup kind, which obviously doesn't look like short-term liquidity driven because of their tenure being 5 years, 7 years, 10 years. So that was just actual numbers. Unless somebody says that I misinterpreted, the FI numbers were too low to be for liquidity to be held responsible for that. But in the US, the issue is that if the Federal Reserve has bought whatever $3-4 trillion of these bonds and mortgage bonds and increased their balance sheet, and now they have said in black and white that over some X number of years, it could even be 5 years, 7 years, who knows, but they have to go back to zero. That means the bonds that mature and run off, they will not refinance, they will not buy. And the others, they have to sell back. So that means $3 trillion the market has to take, the institutions and individuals or whoever. And they will not buy those at these rates because these rates were not with a, it was not a market clearing rate. It was just being bought and bought and bought without consideration of anything else. So therefore, the interest rates have to go up to maybe 3-4%, which initially I was thinking 2.5%. But if the rates go to 4% in 3-4 years, that is a totally different situation.
So Samir, how do you see the sequence of things panning out? Interest rates, they go higher, liquidity gets tightened, P multiples or high P multiple stocks, they start getting compressed. Now, this is a template which is the historical template. Will this historical template play out again?
Well, we have nothing else to go by. So let's look at it not like that. Let's say that in general, this just means that in your mind, the backdrop has to be that we have to invest because over time these things have been done before and the markets still do well. All that means is that, for example, today, now because there's a budget in 2 days, I will say I'll wait for the budget. Actually, I'm not waiting for the budget. In my mind, I am waiting because I know that the markets are not going anywhere big. They may go up 1% here or 1% down. Then I will say I will wait one more thing. I will wait for UP election. Actually, I'm not waiting for UP election, but in my mind, I know that the market is not going anywhere. By that time, say in 1.5 months, the US market also would have properly discounted. Whoever has to sell would have sold, or they may have expected or discounted more rates than actually may happen. And so in that 1 month, 1.5 month, if the market goes up a little bit, I don't mind, but I don't think it's going up a lot. It may fall also a little bit, but that gives me time. But I will say to myself, I am waiting for budget. Now I am waiting for elections. And that is how life is. You will wait or not be under pressure to invest every dollar. Previously, if we got a dollar, we wanted to invest it as soon as we know that that fellow is about to invest. Now all we are saying is relax. Wait for 1 month, give whatever reason you want to give to it, but let these things solve or settle. They will not solve in 1 month, but in a market sense, they can settle because of discounting. Because the market may think now there'll be 5 interest rate hikes this year, which is actually they've started thinking like that, thinking that the March rate will be 50 basis points. So let it come a little near. Because I don't think it is running away this year, a US market. Now the question is whether the Indian market can do so much better that every day that I'm not in the, I mean, here we are in the market, we are talking about the last marginal investment that we make or a little bit that we sell, buy something else with it. I think that pressure is less now. But I don't think the expectation for Indian market is that it is falling apart. And US market also, there is this, although there is no Fed put right now because people feel that he came out very strong. But if the market fell 15% more or 10% more, maybe the five rates will anyway become five rate hikes. So in that sense, there is no panic, but neither is there any pressure to every morning think that I have 5% cash, what should I do with it? Or in my long short fund that I am at 60, do I go back to 65, 70 or not because the market is looking up today or because no, that I don't feel anymore right now.
Samir, final question. Now, if I look at the previous rate hike cycle, the Indian markets were at a different level of valuations, but the earnings were also at a different level of valuations. Post 2015, we saw a big problem with bank NPAs. We saw crisis in the power sector. We saw a lot of corporate sectors going belly up. That is unlikely to happen. What does that mean for us?
Thing is, if you're talking, see, I also was taking that same argument that we have seen from 2004 and 7 a very big series of interest rate hikes in the US, and similarly from 15 to 19. But that time the thing was that was being done to normalize because the inflation itself was not high. Now it is not just a matter of normalizing thing. There is an inflation which is running at 7%, and some of it will again become okay, hopefully with some supply chain coming back, some workers coming back or whatever. Because semiconductor also is not being solved so fast. So let us say on its own it would have come from 7 to 5, 6, and then the pressure on interest rate makes it. But still you need some of these hikes. Now the problem with India is actually Indian inflation is not that high. Indian inflation relative to our band is not high. For us, it is 4 plus minus 2, and it is within that. But the thing is, if US has three interest rate hikes, I think India will also need one or two, because then otherwise, maybe the rupee will weaken, or people will feel. I mean, the markets will feel that India is not reacting or letting it be too loose. So these are unintended consequences of being in a global setup. So I'm saying that therefore your normal market is now capped plus minus some 10-15%, which uh, is what I'm saying, that therefore I'm not hyper anymore about the market in terms of whether I'm fully invested or I'm 90% invested. It's okay to keep 5-7% cash and maybe use it as a to buy something if it corrects, and if it doesn't correct, it's not going up so much that my either a few extra shorts or some cash is going to seriously hurt me. That is all I'm saying right now, because I don't know exactly now how these things turn out, but there seems to be a drag right now on the world and on US, and therefore indirectly on India.
Samir, Tuesday is the budget. Post the budget speech, if you have to tweet something, where if you want to tweet something, Samir Arora doing Bhangra, post the budget speech, what is that you would like to see here from the finance minister, which will force you to tweet a picture in which you are literally doing Bhangra and celebrating the budget?
So first thing is, this time it is not possible, as I've told you, and I don't want to repeat it, that for the first time in 28 years, I will be a bit, I will not be able to see the budget because I'll be in the air. But the thing is, if I can do a Bhangra the next day, I will do it. If you say that directly for the market is only to do with capital gains tax, because we are one of the only countries in the world which charges tax to foreign investors, and it has still not been resolved uh, after so many years, that how is it that only India charges capital gains tax, because of which if you look at the world ETF of equities, which has the one I saw, I think 60-80 billion dollars, the investment in India is zero.
Okay, so let's see what you finally do tweet after the budget, and we will look forward to that. Samir, it's always a pleasure talking to you. Thanks so much for joining us live today on The Market.
Thank you very much. Best of luck.